Hey, good morning, everyone. Marty Mazzora here. Friday, the 26th of August, 2022, about an hour and a half before the market closes this morning. So it's been well over a week since I last updated anything for you in terms of the technicals for the S&P. That's all I'm going to do this morning. I'm going to try to keep it quick. I will circle back probably late this afternoon, this evening, or tomorrow with your normal economic update. Haven't had a chance yet to score our index. So, anyway, readers of the blog especially know that I contracted COVID week before last on vacation, got back to not um, expose or infect the family. I immediately headed straight up to our little place up in the hills. Been working from there all week. Still testing positive. I'm about like 90% better. I would expect to be better by Sunday and then head back down the mountain and work from the office next week. But, we'll see. Everything's fine though. So, with regard to the market, this looks pretty consistent to me. It certainly is consistent with the signals or the analyses that we've been doing here um, most recently. Recall that, before we hit this 200-day moving average right here, I was showing you some historical reasons, bear market reasons to believe that that's probably going to happen and it's probably going to be rejected. And, way back in here somewhere weeks ago, we targeted 4,300 as our bear market rally high or highest level that we thought it could get. And that's pretty much exactly what happened. So we had our 4,300 target on the S&P and then the 200-day moving average and literally just touched it and then failed against it and really hasn't tried to retest it since. We do have a gap right here that will ultimately get filled. The market will come back. And also you may recall that when we were looking here at 4,100, I pointed to the fact that 4,100 on the S&P, once you get below there, right, probably about right there, there was virtually nothing protecting you from 4,000 from a technical perspective, right? News, yada, yada could come in the meantime. Today, as I speak, this is a Bloomberg chart, it's always 15 minutes delayed, but for real time, we're at 4091. So we break below this 4,088, call it 4,100, which is that 38% retracement back of this decline that bottomed right here so far. That becomes a support and resistance line, and of course these things tend to work really well. You can see that when we first breached it right here, came back and tested it, looked like we were above it, but then really just had this period of consolidation here, almost an island topping pattern, and then fell back below it. You may recall we went through all of this, the gap that I said would get filled, the gap that would get filled, bottomed right here, came up, filled this gap, pretty normal right here, just above the gap, and then struggled with it, tested it. It was good resistance for a while, broke above it, then tested that support right at near the bottom of this gap, and then of course here we are. And so now again, we're back right at this level that was support here. So, we could see a few days of consolidation like we did here, if indeed we're going to go lower, which is still our base case. And then I think you get some pretty solid support and testing against that 4,100. Could see a nice, or I'm sorry, 4,000. Could see a nice bounce off of there. Ultimately, we believe this all fails and we get back to, at least testing these lows back in here. Our target from the get-go has been around 3,500 on the S&P. So all of that subject to change as we go, but right now we think that's still a pretty decent analysis that will continue to work as we go. You've got a sell on the MACD from a really high position here. You were very overbought on the RSI. Looks like we're gaining some momentum here on the way down. And so not much for the bulls here until we get to about 4,000. But again, markets are dynamic and therefore our analysis must be as well. So things can change in a hurry. Chairman Powell spoke this morning, of course, wrote a lot about that leading up to that. He did, kind of echoed the last Fed meeting commentary. Sounded pretty hawkish, certainly very hawkish for him. not as hawkish as some of the quotes that I featured that some of his governors have been talking about lately. The theme among the governors is that the market just isn't understanding what they're going to be doing going forward. Powell doesn't really say that, but the rest of them do, and the market seemed to take him at his word, and that is that inflation is going to be their number one concern right here, and they're going to have to probably inflict some pain onto the economy to get inflation under control. Also, though, recall that there was a tremendous amount of support under this market from an options hedging, and particularly how the dealers have to hedge that exposure. I mentioned, and this is from the expertise of who we hire for this data, that with the recent August expiration, kind of opened a window maybe for some downside as some of that support under the market went away. Could potentially go away big time in the September expiration. However, we do still, or at least up until last week, we'll know later this afternoon if that very large net short interest under the S&P remains. Recall, folks, that when you have a tremendous amount of short interest and the market goes against the shorts, they have to buy to cover, or they will buy to cover, and that can provide some real oomph to the upside. I saw yesterday's nice rally is probably a short covering rally. Doesn't mean that the shorts can't get it right, which is what they presume to be getting as of I speak at you today. Bottom line is future speculators are uber bearish the stock market, certainly the S&P 500 right here. And our commentary has been pretty consistent with that. We do think opportunities lie in the not too distant future, but they lie at lower levels and so on. Okay, so let's just look at the 60-minute chart here, and I may just let you go after that one. You can see we had this very distinct rising wedge here, and at least in the RSI we had a bearish divergence, certainly a longer term divergence here on the MACD as well as here on the RSI. Really bearish short-term setup there, and sure enough it did what it should do. Fell apart. Yesterday I drew this trend line right there, and we had basically 1, 2, 3, and then tested it again today, and have just fallen apart off of there. Pretty vivid here, that gap between say 4,100 and 4,000. Just nothing there. It's kind of an air pocket, you would think. So all things being equal, from purely a technical perspective, this makes a lot of sense, and that would be a pretty precipitous drop. Could actually happen today, which would make today kind of historic in terms of the size of the decline. But whether it happens today or it happens Monday or happens at all, getting it all out of the way at once, nothing necessarily wrong with that, unless you're just you freak out every time you look at valuations within some of your holdings. Next weekend is Labor Day weekend, and then we get into September, which historically is like the only month on record that has a negative average return over the years. And traders are very aware of that. You'd think you'd be getting in front of that, and you'd see the market begin to fall off this next week. We'll see. August has still been net positive, although today takes a big chunk of that. If you could get a good run in August and maybe an early run in September to the upside, and then you get quarterly rebalancing off of what's been a really good quarter for the stock market, that could be kind of a negative pull there as well. But our time frame based on the technicals, the longer term charts, which I think we'll skip today. I'll update you on the weekly and the monthly next time. But really kind of pointed to mid-late fall this year, if we had to put a timeline on it to kind of reach that bottom zone that we think becomes a compelling place to add to risk or to add to stocks, all things being equal. Of course, we may change our tune between now and then based on the information and the data that comes in. I don't suspect, even all things being equal, that we would want to go completely unhedged even then when we start picking up what are some of the good ideas on our shopping list right here. So folks, anyway, let me leave it there. No surprises here. Again, a little less of that structural support or that positional support under the market that's been so important to the bulls here of late. That has been waning. particularly if any of these shorts have covered over the last couple of weeks, what would really offer some downside oomph would be if those shorts finally gave up the ghost or used these big declines like this to cover those positions. Nevertheless, though, technically, a lot of downside risk here. Fundamentally, absolutely, there's some downside risk here, and that's what sort of information I do on the written blog. So I'll stop rambling there. Hope you have a wonderful weekend. Again, you'll get something from me probably in the next 24 to 48 hours on the economy in video form. And take care. Thanks for watching and listening. Bye-bye.